Warren Buffett, the Oracle of Omaha, is a legend in the investing world. His journey began humbly in Omaha, Nebraska. Even as a young boy, Buffett displayed a keen business acumen.
I started small, selling chewing gum, Coca-Cola bottles, and magazines door to door.
Buffett's early ventures instilled in him the value of hard work and smart investing. He bought his first stock at age 11. He purchased shares of Citi Service Preferred at $38 each. He later sold them for a small profit, a decision he would soon come to regret. The stock later soared to $200. This early experience taught Buffett a valuable lesson about patience.
I realized the importance of long-term investing.
His story demonstrates that anyone can start investing even with limited capital. The key is to start early and stay committed. Buffett's journey is an inspiration to aspiring investors everywhere. His story teaches us that success doesn't happen overnight. It requires patience, discipline, and a willingness to learn from mistakes. One of Warren Buffett's core investing principles is the power of compounding. Compounding is like a snowball effect in finance. Over time, even small amounts of money can grow exponentially. The key to harnessing compounding is to start early and reinvest your earnings. When you reinvest your profits, you earn returns on your original investment and accumulated earnings. This creates a powerful cycle of growth that can supercharge your returns. Imagine investing $1,000 at a 7% annual return. After the first year, you'd earn $70 in interest. In the second year, you're earning interest on $1,070. As you reinvest, the snowball gets bigger. Starting early is crucial. The earlier you begin, the more time your money has to compound. Even small contributions can grow into a significant nest egg. Time is your greatest ally in investing. Warren Buffett famously advocates for investing within your circle of competence. This means focusing on industries and businesses you understand. When you invest in what you know, you're better equipped to assess a company's true value.
I avoid chasing after trendy investments or complex financial instruments I don't fully grasp. Instead, I stick to companies with straightforward business models and strong track records.
He prefers businesses that sell products or services he understands and believes in. For example, Buffett has long been a shareholder in Coca-Cola. He understands the beverage industry and recognizes the enduring appeal of Coke's products. This deep understanding allows him to make informed investment decisions based on a company's fundamentals rather than market hype. Investing within your circle of competence doesn't mean you can't explore new industries. However, it's crucial to thoroughly research any company or sector before investing. Understand its products, market position, and competitive landscape. Knowledge is power in the world of investing. While Warren Buffett is known for his investments in blue-chip companies, he also recognizes the potential of small-cap stocks. Small-cap companies are those with a relatively small market capitalization, typically under $2 billion. These companies often fly under the radar of institutional investors, presenting unique opportunities for individual investors.
Finding promising small-cap companies requires diligent research and analysis. Look for companies with strong management teams, solid financials, and a competitive edge in their respective industries. Pay attention to their growth prospects and how they plan to navigate market challenges.
Small-cap investing can be more volatile than investing in larger, more established companies. However, it also offers the potential for higher returns. By carefully selecting small-cap companies with strong fundamentals and growth potential, investors can potentially outperform the market over the long run. Remember to diversify your small-cap holdings. Don't put all your eggs in one basket. Spread your investments across different sectors and industries to minimize risk and maximize your chances of success. Warren Buffett's investment in Candies is a classic example of his investing philosophy in action.
In 1972, Berkshire Hathaway acquired Candies, a California-based chocolatier known for its premium products and loyal customer base. At the time, Candies was already a profitable business. However, I recognized its strong brand, pricing power, and potential for growth. I was particularly drawn to the company's ability to consistently raise prices without alienating its devoted customers.
The Candies acquisition proved to be a highly successful investment for Berkshire Hathaway. The company continued to generate strong cash flow and expand its operations. Buffett has often cited See's Candies as an example of a business with a moat, meaning it has a durable competitive advantage that protects its profitability.
The See's Candies story highlights the importance of investing in businesses with strong brands, loyal customers, and a track record of profitability. It also underscores my preference for companies with simple, easy-to-understand business models.
As your investment portfolio grows, you may face challenges in scaling up. Finding suitable opportunities that align with your strategy and risk tolerance is key.
Smaller portfolios offer more flexibility with individual stocks. Larger portfolios face challenges in finding impactful investments. Diversifying into bonds, real estate, or private equity may be necessary.
Managing a larger portfolio's complexity is another challenge. Rebalancing and staying updated on market trends becomes time-consuming. The stock market is inherently volatile. Prices can fluctuate significantly in the short term, driven by a variety of factors such as economic news, geopolitical events, and investor sentiment. As an investor, it's essential to understand that market downturns are a normal part of the investing cycle. When market volatility strikes, it's crucial to remain patient and avoid making impulsive investment decisions based on fear or panic. Remember that stock prices are driven by both rational and irrational factors. Overreacting to short-term market movements can lead to costly mistakes, such as selling low and buying high. One of Warren Buffett's most famous quotes is, "Be fearful when others are greedy, and greedy when others are fearful." This means that instead of following the herd, you should look for opportunities to buy quality assets when they are undervalued during market downturns. Remember that investing is a marathon, not a sprint. By staying focused on your long-term goals, riding out market fluctuations, and sticking to your investment strategy, you can increase your chances of achieving financial success. Diversification is a key principle of risk management in investing. It involves spreading your investments across different asset classes and regions.
Imagine you invest all your money in a single stock. If that company faces difficulties, your entire portfolio is at risk. Diversifying across multiple companies and sectors minimizes this risk.
Diversification helps manage risk and enhance returns over time. Investing is a long-term game. It's not about getting rich quick, but rather about building wealth gradually over time. Warren Buffett's investment philosophy is centered around the idea of finding high-quality businesses and holding them for the long haul. When you invest for the long term, you're able to ride out market fluctuations and benefit from the power of compounding. Short-term market movements become less relevant when you have a long-term perspective. Focus on identifying companies with strong fundamentals, sustainable competitive advantages, and a track record of profitability. It's important to have a clear understanding of your investment goals and time horizon. Are you saving for retirement, a down payment on a house, or your children's education? Your investment time horizon will influence your asset allocation and risk tolerance. Remember that investing is a marathon, not a sprint. By staying patient, disciplined, and focused on the long term, you can increase your chances of achieving your financial goals. There are countless resources available to help you learn about investing and improve your investment skills. One of the best ways to learn is by studying the strategies and philosophies of successful investors like Warren Buffett.
Read books, articles, and watch interviews to gain insights into their investment decision-making processes. Pay attention to their risk management techniques, their approach to valuation, and their long-term outlook on the market.
In addition to studying successful investors, take advantage of the wealth of educational resources available online and offline. There are numerous websites, blogs, podcasts, and online courses dedicated to teaching the fundamentals of investing.
Consider joining investment clubs or online forums where you can connect with other investors, share ideas, and learn from each other's experiences. Surrounding yourself with like-minded individuals can provide valuable support and motivation on your investment journey.
Investing is a journey, not a destination. It's about making informed decisions, staying disciplined, and remaining patient over the long term. Remember that even Warren Buffett started small, investing his hard-earned money in his first stock at the age of 11. The most important step is to start investing. The earlier you begin, the more time your money has to compound and grow. Don't be discouraged if you can only invest a small amount initially. Consistency is key. Even small contributions made regularly can add up over time. As you gain experience and knowledge, you can gradually increase your investment amounts and explore different investment strategies. Remember to invest within your circle of competence, diversify your portfolio, and stay focused on your long-term goals. Investing can be both challenging and rewarding. By following the principles outlined in this essay, you can increase your chances of achieving your financial goals and securing your financial future. Start small, dream big, and enjoy the journey.